He brings unparalleled academic expertise and this is key, practical economic leadership. Please join me in welcoming Mr. Chiappori on stage.
Ladies and gentlemen, it's a pleasure to be here. I'm a Minister of Finance, as was just said, but full disclosure, all my life I've been an academic. And before joining the Monaco government, I've been an academic in the United States for nearly 30 years. First at the Department of Economics of the University of Chicago. And you will see a lot of Chicago economics in what I'm going to present. And then at the Department of Economics of Columbia University, New York. So what I'm going to present would be something that will be A, very academic, and B, it will be the vision of a labor economist on recent evolutions. So what I'm going to do, the main intuition of this kind of gathering is not some kind of scholarly presentation. It's really starting a discussion, and there are lots of expertise in this room that I would be very eager to hear about. So I'm going to put some facts. And the facts are what they are. Of course, what's tricky is the interpretation of these facts. So at the end, I will put one slide, which would be my tentative explanation or interpretation of those facts. But now I'm very more willing to hear what you guys have to say about this. Can you? Oh, that's good. Yes, that's going to help. So the title is Human Capital, Technical Progress and Inequality. The notion of human capital, that the standard definition of the World Bank. The point here is that we talk a lot about physical capital. Human capital is, if anything, much more important than physical capital. And one thing we know, and we have known studying growth for many, many years, is that when it comes to growth, when it comes to innovation, when it comes to inequality as well, human capital is completely crucial. And I will try to convince you that you can see that loud and clear in the data that I'm going to show. Human capital is a result of an investment, and then now it's a bit unfortunate because part of the slide you cannot see because it's big, but you can see that on the sides, right? There are 2 points that I want to make. The first thing, which is I think not really debatable, is that one of the main, maybe the main driver of human capital acquisition is technical progress. And in a sense, the logic of capital accumulation follows and is shaped by the evolution of technical progress. And in particular, we're talking about artificial intelligence. It's clear that AI makes a big change. Now, my second claim, which might be more debatable, is that there has been a very significant shift that you can see in the data around 2010. There is the pre-2010, let's say 1980 to 2010, in which some kind of patterns emerge very clearly, and those patterns are completely reshuffled after 2010. So let me come to the details. So this is the general roadmap. I will first start about the pre-2010 period, 1980-2010. Then I will try to argue that 2010 is a very significant shift. And then conclusion, I will be very brief because that will be hopefully a common point. I'm going to talk about 3 things. And again, I'm just going to show you data, graphs. What I call the diffraction, the role of human capital, and very shortly a supply-demand story. Okay, let me start with this. This is very spectacular, by the way. This is a real family, this is the US. Real family income in the US between 47 and 2010. As percentage, the basis is 173. There are 2 things that you see on the left-hand side of the graph, which is before 1980. First, very quick growth. It doubles over 30 years. There are very few precedents in economic history of a growth at that speed. But the second thing is there are 3 curves here, but you don't see them because essentially they coincide. The 3 curves correspond to 3 different levels of income. What's really remarkable is that the income growth was affecting each and every slide of the population at exactly the same rate. And when you look at post-1980, that's what I call the diffraction. Then it explodes, and if you look at the top of the distribution, it continues to grow pretty much at the same pace, but the median, and especially the bottom of the distribution, they are at best stagnating and actually, if not, declining. That's a fact. Second fact, quite shocking actually, life expectancy. I didn't put this. This comes from a book from my friends and colleagues, Ann Case and Angus Deaton from Princeton. Before 1980, what you see is a very spectacular increase in life expectancy, pretty much 3 months every year, which is, again, huge and unprecedented. But the US were in the middle of the pack and growing at the same speed as everyone. And what you see starting in 1980 is that all of a sudden, the pace has been lost for the US, to the point that, despite the fact that the US is much wealthier than Portugal, US life expectancy in the US used to be 2 years more than Portugal, now it's 3 years less. How can we explain that? This one is even more depressing. This is a medical paper published in the top journal. This is the volume of frontal gray matter. So it's physiological. There is nothing like a test, an interpretation, or whatever. They're just measuring, using MRIs, the size, the volume of the frontal gray matter. But depending on the social origin of the kids, and this is between the age of 6 months and 3 years, and you see that they start pretty much at the same point, and you see this extraordinary divergence between the level of the family. Now, I remember a discussion I had with Gary Becker years ago. He was saying, inequality sounds like a bad word, but replace inequality with high return to human capital, it seems much more acceptable. Which, it's very difficult to say that inequality is always bad. And actually, inequality can provide the right incentives or things like this. But one type of inequality that's very hard to accept is inequality at birth. And this is very close to inequality at birth. It makes a huge difference which family you are born into. This is a graph that you might know. It's called, in the economic literature, well, there is no graph for the moment, but it's going to come, the Great Gatsby curve. So, just to tell you what's on this graph, the horizontal axis is inequality, short-term cross-sectional inequality. You look at the distribution of income at a given moment, and you measure the inequality. So the very unequal country will be to the right, and the less unequal country will be to the left. Vertical axis. This I'm going to measure, well, the author of the graph, I didn't make this graph, of course, will measure intergenerational mobility. Now, what we have in mind here is the following narrative. It's the so-called American dream narrative. The narrative goes, of course, the US is extremely unequal. You will see that, and we know that. But this inequality at any given moment is the price to pay, because the US is a land of opportunity, and the US is a unique country in the sense that your parents can be at the bottom of the income distribution, and still the kids have a chance to make it to the top. And in general, the narrative, if you want to generalize the narrative would be, we have some countries that are very unequal, but very mobile. Now, the axis is defined in such a way that the higher you are on this axis, the less intergenerational mobility you have. In a sense, the interpretation of this 0.5 here is how much can we know about the kid's income if we know the parents' income. So if we know a lot, that's typical of a very frozen society. So the narrative would be, there are countries here to the bottom right, and those are very unequal but very mobile. On the other hand, we have let's say the old Europe, which is less unequal and in any static sense, but much less mobile as a society. So essentially, we should expect a pattern that will be decreasing. Okay, that's what you expect according to the narrative, and that's reality. It's exactly the opposite. What we see is The most unequal countries to the right are also the country up there, the country which have the smallest level of intergenerational mobility, and the US is just at the top here, with the United Kingdom and Italy. Okay, those are the first series of facts. I've not been talking about human capital now. Let me introduce human capital. The first thing I'm going to do is I'm going to change the measure on the horizontal axis. Instead of putting an index of inequality, I will put essentially what we call the college premium. What's the college premium? Well, you look at the wage of people who have a college degree. Remember that college in the US is 4 years after the end of high school, right? So it's the university education, 4 years university education. So you look at the wage, the average wage of people with a college degree, you look at the average wage of people with only high school, and you look at the ratio. So in other words, to the right, I will have countries in which the fact that you have a college degree makes a huge difference in terms of wages. To the left, you would have those in which university education is less important. It's pretty much the same graph, with one exception, which is Italy. I'm not going to talk about Italy, but Italy seems to be a very special case. And there are reasons for that, but I don't have time to elaborate on this. But so essentially, there are lands of opportunities. They are here. Australia, Canada, New Zealand. Of course, there is Northern Europe, which is very mobile and very equal. But one thing that's very striking is that those countries which are less mobile and more unequal, they're also the countries in which university education matters a lot. So that's the first, of course, it's a correlation, it's not a causality, but it's the first hint, right? It's the first clue. That's the college premium in the US. Again, remember, what you do is you take the average wage of college educated, the average wage of high school educated, and what's the difference? So the bottom of the graph here is 30%. It used to be 30% in the 60s. Now, in 2010, it's more like 60%. That's a huge increase, right? It has been doubling over the period. And the other graph here, it's not college education. This one is post-college education, like law degree, medicine degree, PhD, this kind of stuff, MBA. And it has been increasing even faster. There is a very significant difference between men and women, by the way. I don't have time to talk about this, but I've been working for 20 years on this difference between men and women. It's a fascinating topic. But anyway, the story before 2010 is huge increase in the market value of a university education in terms of wages. That's the same, but in dollars, constant dollars, 2009 dollars. It's true in terms of wages. It's also true in terms of unemployment. The unemployment for people with a doctoral degree or a professional degree is pretty much zero. 1.5%, it's just people changing job, whereas less than high school and even high school diploma, the unemployment rate is much higher. Again, this is 2010. And let me come back to this. We remember this kind of change of pace in the evolution of life expectancy. The next graph, coming still from the book by Angus and Anne, I'm going to distinguish within the US between college-educated and high school-educated people. And here is what you get. Actually, if you replug college-educated people, college and more than college, if you replug this in the previous graph, those people are following pretty much the European trend. Those people are left behind, and in a quite spectacular way, as you can see. So the story between 1980 and 2010 is education, and in particular, college education makes all the difference. Maybe not all the difference, but a huge difference. This is my very short supply-demand story. It's just one graph by David Autor from MIT. So what David does is the following, and he's using data until 2010. He looks at all the jobs in the US. Actually, some jobs are part-time, some jobs are have overtime. So he look at the total number of hours. And he asked the following question. Over all the hours that have been used in the US working, what fraction require a college degree? And what you see is that in 65, it's less than 20%. In 2012, it's more than 50%. So what it's telling you is that from the productive sector, there has been a huge demand for education, and in particular for university education. And the supply-demand story, I don't have time to talk about the supply story, but the supply does increase a little bit, so people are more likely to go to college in 2010 than in 1970, especially women, by the way. But it's not sufficient to catch up. And of course, when demand increases and supply cannot follow, you expect price to go up, which is exactly what has been going on. So, we have a sort of coherent story about 1980 to 2010, huge demand for human capital, but in particular for the kind of human capital that's produced by a college education. Supply does follow a little bit, but not enough. Prices go up, and we see this huge difference. Now, here I'm pointing, what are the reasons for this? One reason is technical progress, of course. I'll come back to that in a minute. International trade might play a role in the sense that many countries, including the US, have been outsourcing unskilled kind of jobs and concentrating on high-skilled jobs. I mean, then there is some debate about the respective importance. Everybody agrees that technical progress has been crucial. Okay. Now, let's see what's going on in 2010. This graph I stole from The Economist. By the way, The Economist is an extremely interesting reference on all these kind of issues. That's between 2010 and now. And what you see is that the wage that have been increased fastest are the wage at the bottom on the distribution. So just the opposite patterns of everything we saw before. College premium. It peaked in 2010, but now it's at best plateauing and actually decreasing. And unemployment. Now, here, that's the unemployment rate. It could be smoothed away. Those are the raw data. But the point in blue is high school education. Red is college education. What you see peaking in 2010 is the huge difference in terms of unemployment rate between college and high school. And it's shrinking. It has been shrinking since 2010. And now it's hard to see the difference. The difference is basically non-existent, or at least very small. By the way, this is the same graph, except that I'm replacing college education with the so-called associate degree. So those are professional kind of education. So this will be the education like 2 years after high school, like a plumber, an electrician. People repairing elevators. For some reason, there seems to be a huge demand for people repairing elevators, and there's been. But the point is, now you see that the difference is maintained, maybe not as important as before, but you still see the very clear ranking. So at least the conclusion here is that the value of college education is definitely not the same now as what it used to be in the past. And you see that in demand, while the supply of education, when you look at historical college enrollment, what you see is that there's been this huge increase between 1970 and 2010. It's peaking in 2010 at 18 million, but since then it has been declining. People are less willing to get a college education, which seems to signal, if people are rational, that the value of a college education is not as large as what it used to be. Note that, well, of course, the scale doesn't make it very easy to see, but we don't see anything like this for post-college education. Those are the PhDs, low degree and so on, and here the numbers are still increasing. Okay, I'm done with the data, so my conclusions. First of all, the inequality in the developed world is human capital. There's been all this literature about the role of financial wealth. And the top 1%, they got rich because the interest rate is larger than the growth rate and so on and so forth. That might be true for the top 1% or the top 0.1%. I'm not even sure. In the US, it's not clear. I mean, the wealthy people now in the US are not the people who were wealthy 30 years ago and benefited from the interest rate, but whatever. But definitely for the bulk of the inequality, it has to do with not with financial wealth, but with human capital, not with financial capital, but human capital. Between 1980 and 2010, the key was getting a college degree, getting a bachelor degree. And my interpretation of this in terms of technical progress is that technical progress, broadly speaking, all over this period, was A, a substitute for unskilled work, and B, a complement for skilled work, but skilled labor being essentially the kind of skill that you can acquire with a college degree. And what you see when you talk with people about hiring policies, right? At that time, the kind of reaction was something like, we want to hire people with a college degree. We're not that demanding regarding which university or even which field, which major. The college degree is what we need because those people, we're going to train them and so on and so forth. What about now? The first thing, some of my friends call me a Marxist because if you think of it, this is very Marxist in the sense that what I am going to is those kind of deep patterns that we see in the economy, they are a reflection of changes that take place on the productive sector. Of course, I'm definitely not a Marxist economist, but my interpretation here is that in particular with AI, some of this technical progress become a substitute to skilled labor or maybe to some skilled labor. You know, what kind of jobs is AI replacing? Well, it's replacing accountants. It's replacing lawyers. It's replacing some doctors. You know, if you're a radiologist, what's radiology about? You see a kind of very kind of informal, misty picture, and you have to recognize patterns. Recognizing patterns is something that AI does much better than any human mind. So we were in a situation in which technical progress was a substitute for unskilled labor. Now things are much more complex. So the college degree is much less essential. And in fact, when you look at hiring policy, people concentrate less on college and more on college plus. And even on college, they concentrate much more on specific majors and specific universities. Like if you have a major in bioengineering from MIT or Stanford, you're in a good place. But if you have a major in creative writing, it might be more difficult. Another thing, the importance of professional training. Another thing I read in The Economist, which I loved, apparently there is an advertisement in the London subway, in the tube. And there are two posters. First poster, it's a question. The question is this one: AI, can you bend this copper pipe for me? And the second one, the AI is answering, no, I'm sorry, I cannot do that. The point is, the plumber is not someone that's going to be replaced by artificial intelligence, but the accountant might be. The people within the law firm looking at precedent might be. The radiologist might be. Now, I'm not saying that those jobs will disappear. On the contrary, they will change, they will become much more productive because of the help of artificial intelligence, you will need less accountant. The power of an accountant will be multiplied by the access of these incredible tools that are provided by artificial intelligence. But in terms of the importance of the kind of education, what I expect is, on the one hand, professional training becoming more important, and second, I would expect a success in advanced degrees in specific fields. So the fact that bioengineering at MIT is good, that's here to stay. What's important is will be less and less what you learn, and more that you learn how to learn the new technology that will appear. Thank you very much.